Thank you, Shobji, for all your support. Hi, everyone. Good morning. I hope everybody has joined in. I'm just waiting for a couple of minutes so that whoever is joining in can join, and then we can start for today's discussion. Okay. I hope everybody has joined in. Let's start. So we will be covering two standards in our today's discussion. First of all, we will start with India's one presentation of the financial statements, and the second one is India's 34 interim financial reporting. Right. So we'll start with India's one. So I before we actually start with the question and answer, I just wanted to know. I expect that everybody must have been revising the standards after the main classes were conducted. So hope you are on the top of the concepts given by these standards. But still, I would like to briefly revise key matters of this India's before we actually jumpstart. So what India's one actually tells us, what are the key guidance or guidelines India's one provides to us? Any guesses? Any recalls you are able to make? So first of all, it talks about the presentation of the financial statements. It tells you what exactly the financial statement set means, right? So the complete set of financial statements is, you know, uh, given by the India's one. What does this contain? It contains a balance sheet, a statement of profit and loss, a statement of changes in equity, a statement of cash flows, and the notes comprising significant accounting policies and other explanatory information, right? So these are the five items which, are covered by the complete set of the financial statements as stipulated by this India's one, right? Now, when we are preparing the financial statements, so for example we are preparing the balance sheet, right? So we need to give the current year column as well as the comparative year column, right? Preceding period, right? For example, if we are preparing the financial for 2000 March 2025, then March 24 will be the preceding period comparative numbers. Similarly, it goes for the P&L, and similarly it goes for statement of cash flows and other notes to accounts as well, right? So we need to give comparative numbers or comparative explanatory notes whenever we are giving any notes to accounts, right? So that is the very basic expectation set by this standard. Now, as you are aware that, as and when company does any reclassification or restatement or change in accounting policy, right? So these are the matters, which requires entity to give a third balance sheet as well, right? You must have heard this in the Ind AS 8, right? So as and when company does any error correction or any change in accounting policy or any reinstatement, right? So third balance sheet will also get triggered, right? So what third balance sheet would mean? So third balance sheet would mean, for example, March 25 is the current year column, March 24 is the preceding year column, and 1st of April 24, that is beginning of the comparative period, right? Beginning of the comparative year would be the third balance sheet column. So that will also be required in that case. So that forms part of the complete set of the financial statements in that case, right? So this is all we discussed during our main classes, right, in detail. So I'm just quickly revising few of the matters before we start doing the questions. Then there are certain general features, explained by the standard. For example, presentation of true and fair view and compliance with the India's, right? So you must have heard that, whenever an entity is preparing India's financial statements, they need to give a explicit and unreserved statement about the compliance of the India's, right? So the entity says that, to the best of our knowledge, we have complied with all the accounting and disclosure requirements of all the NDS is applicable to us, right? So this is how an explicit and unreserved statement needs to be given in the financial statements. If this statement is not given, then the financial statements will not be treated as prepared under NDS. So that's the very stringent, requirement of this NDS, right? Then going concern, accrual, materiality, offsetting, frequency of the reporting. So all these, attributes were discussed in detail in this India's one. For example, what does going concern mean? Going concern means an entity expects to run its business for next 12 months at least from the reporting date, right? So if this assumption is hit, then the financials will not be prepared on a going concern basis, right? So we have to assume that company will be running its business or continuing with its business for at least next 12 months from the reporting date. That's what the going concern assumption is. So basis on this assumption, we prepare the financial statements, right? Then accrual basis of accounting. So there are two bases, cash basis or accrual basis. So we have a framework defined that everything we need to account for in our financial statements on the accrual basis, right? So as and when the expenses are accrued, they need to be recorded into our profit and loss account, right? So this is the basic assumption, framework assumption. Then materiality and aggregation, right? So at times, we need to take a call while preparing the financial statements. What are the material items, whether they need to be disclosed, separately in the separate line item, or they can be aggregated within another similar, item, right? So this all depends on the materiality. So standard says basis on the materiality, you can do some aggregation or disaggregation as well, right? Then offsetting means any item, can be offsetted against, another item. For example, if you have a receivable from one party and as well as payable to that party, right? So you can go and present it net, provided there is a master net agreement available, right? Otherwise not. So there are certain offsetting rules, which items can be offsetted against each other or which items cannot be, and accordingly we need to, uh, do that. Then what is the frequency of the financial statements reporting? So do I need to prepare the financial statements every month, every quarter, half year, or yearly? What is the requirement? So as such, the standard doesn't cast any requirement that for which period you need to present and how many times you need to prepare and present the financial statements. It is all dependent on the country specific rules and regulations. For example, in India, our financial year ends on 31st of March every year, right? So generally companies used to prepare March financial statements, right? So that is a annual financial statement all the companies are preparing. But it doesn't mean that we cannot prepare the financial statements for any other date or any other period, right? So financial statements can be presented for a quarter, for a half year, or for a year, is for any, date which is considered as the year end date by the company, right? If company goes and prepares the financial statements, the complete set of financial statements, right, for any quarter, right, then it has to mandatorily follow Ind AS 1, right? So Ind AS 1 says, for example, there is a listed company and listed company usually produces the quarterly results, right? So those are the condensed, results, right? But if company chooses to prepare complete set of financial statements for each of the quarters results, then instead of Ind AS 34, Ind AS 1 will become applicable because company has chosen to, prepare complete set of financial statements, and complete set of financial statements are governed by Ind AS 1. If the company doesn't choose this and it goes away with, preparation of the condensed financial statements only, then Ind AS 34, guides how those financial results and financial statements needs to be prepared and presented, right? So that is a very key point to note down. In case company chooses to prepare complete set, Ind AS 1 becomes applicable. Clear? Any questions until now, or anything anybody wants to ask? I'm just waiting for a few seconds. Anything anybody wants to ask, please? Okay. Silence means no queries. Then Ind AS 1 goes on and giving lot of guidance. For example, presentation of the current assets, non-current assets, current liabilities, non-current liabilities, providing the definition of operating cycle, right? So all these matters you must have already understood by now, right? So current assets, current liabilities means all those assets and liabilities which are receivable or payable within next 12 months from the reporting date, right? Rest all things are non-current assets. Okay, deferred tax asset. Anybody can tell me deferred tax asset is a current asset or non-current asset? Any guesses? Deferred tax asset, current or non-current? Non-current, always. Correct, Saminathan. So deferred tax assets doesn't need to be, looked from the angle whether it is, realizable within 12 months or not, right? So it is always considered as non-current, never current. Okay. And which all items you present in the statement of changes in equity? Any points are you are able to recall? What are all those matters which are presented in uh, sorry in OCI, other comprehensive income? What are the matters presented in OCI instead of the PNL? So you remember we have the two, segments in our statement of profit and loss. First is the profit and loss, and then other is the other comprehensive income, right? Under Ind AS. Under IGAP, it is all single statement, but under Ind AS, it is a having a two segments, right? So first segment is my prime PNL, and second segment is other comprehensive income. What are the matters we present in OCI, other comprehensive income? Are there any specific items, or we can go ahead and present anything in OCI? Revaluation, okay. What else?
Yes, sir. Good morning, sir. We will present the revaluation reserve and additional depreciation if the company option to that every year transfer the additional depreciation that also will move to the OCI part.
Right. So changes in revaluation surplus. So what when revaluation surplus arises, one of the example is Ind AS 16 property, plant and equipment revaluation, right? So as and when company does the revaluation of any of its property, plant and equipment, then whatever the revaluation surplus arises, it goes to the OCI. Are you able to recall this? You must have studied under Ind AS 16 as well.
Yes, sir. On those
So
cases, we will
whenever
revalue.
Correct. So whenever there is a upward revaluation, right, for any asset, and there was no historical downward revaluation for that very asset, then the upward revaluation goes and recorded in OCI, right? Right. That's what India 16 has guided. correct?
Yes, sir.
Remeasurements of defined benefit plans is the another item,
Yes, sir.
right? What do you mean by remeasurements of defined benefit plans? So as and when we get the actuarial certificate done for any of our gratuity plans or any other employment related plans, right? So whenever there are any changes in actuarial assumptions from the previous year to the current year, so because of those changes, whatever is the impact on the value of those defined benefit plans called the remeasurement, right? So that impact gets recorded in OCI, right?
Yes, sir.
Gains and losses arising from translating the foreign statement of a foreign venture, foreign statement financial statements of a foreign venture, right? So as and when company does the translation of any of its foreign subsidiary, foreign JV or foreign associate into the INR, then whatever the foreign currency translation reserve arises on translation of those financial statements gets recorded in FCTR, foreign currency translation reserve, right, under OCI until the
Ye-
that subsidiary is disposed of, correct?
Yes, sir.
So these are the specific items which India's one tells or ask us to record in OCI only. So we don't have the choices available here, right? So whatever is specified by the standard to be routed through OCI, we have to mandatorily record all these items in OCI only. We don't have any choices on this, right?
And, and,
So
and
that's
also
what.
in and also in days 109 is talk about that FET, OCI, or NR. Some of the items are there, sir, on the equity
Correct,
liability.
correct, 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 correct. So as and when there are any items which are required to or designated to be recorded through OCI under the financial instruments, India's 32109, right? So all those items gets also recorded and routed through OCI, correct? For example, effective portion of the cash flow hedge. You must have studied this hedge accounting under India's 109 financial instruments, right?
Yes, yes, sir.
So you must have.
Effective in ineffective portions.
Right. So you have studied that these are recorded through OCI always, correct? And if there are any liabilities which are designated at FVTPL under the India's 32, then those are also recorded through PNL. But if there is any fair value change attributable to the change in the own credit risk, that is always recorded in OCI under India's 101. You must have studied this also. Should I give you one example on this?
Yes, sir,
For
please.
example, for example, if a company, right, has taken a loan from the bank, right? If a company has taken a loan from the bank and later on it starts, defaulting on that loan, right? And that liability, that is the loan, right, on the books of the company is a loan, right? It is a liability and it is a financial liability because it is to be repaid in up cash, correct, to the bank at some future date. So this is a financial liability, right? So if this financial liability is designated at FVTPL instead of amortized cost, then the liability fair value change gets recorded in the P&L by default. But because the company is defaulting on this liability and because of that fair value is coming less, right, because of own credit risk, then the amount of fair value pertaining to this own credit risk, that is the company's own credit risk, always goes to the OCI. Clear?
Yes, sir.
Are you able to recall this? You must have studied under India's 109 discussion financial instruments.
Yes, sir. Studied this.
Perfect. So my objective is to just revise key items of this India's one, because I personally believe we generally tend to give more priority to other standards which have actually real practical application, right? And we generally give very less, weightage to Ind AS 1, Ind AS 34, right? All these theoretical standards, right? So because we believe that, there is as such nothing much told by these standards, but that is not true. So these are the fundamental Ind AS 1, Ind AS 34, Ind AS 8, right? So all India is 10. So all these standards, are very basic and fundamental standards which can turn around your, accounting or any accounting matter, right? So in spite of having very less, calculation related matters with these standards, but they are very specific in, providing guidance on the uh, presentation or classification aspects of various items, right? And if we go wrong on this, then our solution becomes wrong, right? So suppose if you are going to prepare a full-fledged financial statements in your examination, and by mistake, whatever the items needs to be presented in OCI, you present in P&L, you will lose the marks, in spite of the fact your financial statements balance sheet are all telling, correct? So we need to be very vigilant. What are the key requirements of the presentation and classification as well, right? Instead of focusing purely on accounting. So let's start now with questions, whatever we have for this Ind-AS. So this is the first one. An entity has placed certain deposits with various parties. How the following deposits should be classified? Current or non-current, right? Electricity deposit. What do you believe? What to do with electricity deposit? Current, non-current.
Electricity, yeah, electricity we will classify as non-current. Non-current. The reason is that the electricity usage, yeah, if it is for only 1 year, if the business is only for short term, then that case only we can put it as a current. The reason is that
Mhm.
the temporary business, say association of person is joined together to do the short term business for the winter season or something else, then the electricity is cut. Those times we can put that classification as a current. Otherwise it will be non-current. The reason is the electricity is a must for running the business. It we will assume that the company, the going concern concept will be there. It will be run the company for foreseeable futures.
Perfect. Very appropriate. So let's see how sophisticatedly we need to write this uh, basis of conclusion. So electricity deposit is generally considered as long term because company has taken the electricity connection for running its business operations, right? And they are not expecting to wind these operations in a near future. Near future means at least in next 12 months from the reporting date, right? And if that is the case, then it automatically comes out to be the non-current asset unless and until entity says that we are not very sure that we will be running our business for next 12 months, and hence we might need to close down our operations. And in that case, it might be possible company says that electricity deposit, which we had deposited with the electricity department, we can claim a return, right? So practically, in general, electricity deposit is always considered as non-current, right? For the same reason, because no company is saying that we are going to reclaim our electricity deposit within next 12 months from the reporting date, correct? So at all points of time, deposit is recoverable on demand when the connection is not required. However, in practical life, electricity connection is required as long as the company exists. Hence, from a commercial realty perspective, an entity does not expect to realize the asset within next 12 months from the end of the reporting period. Hence, the electricity deposit should be classified as non-current always, right? Tender deposit, earnest money deposit, EMD. What tender deposit or EMD means? What are these items?
So tender deposit, EMD deposit, whenever there is a bid is conducting on the sale, say example, scrap sales is there, that time the tender will be given. The people who is going to participate in the bid, they will deposit some money out of that. If they are winning that, the tender deposit money will not be returned to them. And if they not win, then that time the tender deposit will be released. If the bid period is less than 12 months, then it will be classified as current, otherwise it is non-current.
Yes, yes, yes. Audible now? Now I'm audible. Mm-hmm. Mm. Well, now? The video on back. Oh, fine. Right. So you're talking about the tender deposit, EMD, right? So generally what happens, for example, there are various companies who, participates in various bid, right, which the government, grant the contracts to various construction companies for the construction of highways, bridges, and right. So Size is increased, correct? Hmm. Okay, thanks. Okay, so we were talking about the tender deposits and earnest money deposit, right? So generally, what happens whenever companies participates in any of the construction contracts, where bids are invited by the government, right? So for example, Larsen and Toubro, right? So this is the company who generally participates in various large projects. For example, construction of highways, bridges, roadways, right? All these big size projects which are won by these companies via tenders, right? So before going into the bidding or to be eligible for bidding for these contracts, they deposit certain deposits with the government, right? So those are called tender deposits or earns money deposits, right? Now the question is, if the company has deposited such deposits, right, for any future biddings, then and in between 31st March is coming and you are going to prepare the financial statements, then how and where these standard deposits will be classified and presented in the balance sheet as a current asset or as a non-current asset? That is the question. So what do you think?
Sir, ma'am, yeah, if the tender deposit, say for the bidding purpose, they will do this. Say, example, the scrap sale is there. So many bidder will be joined together, and the date is predetermined. With
Hmm.
this, if it is less than the reporting date, then less than the reporting date means, say, example, the bidding is announced on June. If it is within the 31st March, then which means is the within the financial reporting date, so that uh, whether he is winning or not winning. If he is win, then the refund money they will not issue. If they fail, then they will give the refund money. Those situation he will classify as a current asset, current deposit. Otherwise, it will be non-current.
Perfect. So what we say generally, the tender deposits or EMDs are paid for the participation in the various bids which are invited by the government. They normally become recoverable if the entity does not win the bid, right? So if the entity does not win, then these are refunded to the company after the bidding process is completed, right? Bid dates are known to the company at the time of the tendering of the deposit. So companies always know that which date the bid is going to happen, right? For example, if I am depositing the money somewhere in say February, I am preparing the financials for 31st March, and the bid is going to happen say in 30th June, right? So I know that within next 3 months the bidding process will happen and it will be completed. In case I win, I win. In case I lose, I lose. But after the completion of the bidding process, my EMD will be refunded, right? So I know that within the next 3 months from the year end, it will be refunded to me. But until the date of the actual bid, one is not in a position to know if the entity is winning the bid or not, right? So we never know that whether we will win the bid or we will lose the bid, right? So in case we lose the bid, our EMD deposit will be refunded, and in case we win the bid, they may be adjusted accordingly, depending on the terms of the deposit. If the entity expects to realize the deposit within a 12 months period, it should be classified as current, otherwise non-current, right? So it is always dependent on circumstances. So there is no clear thumb rule answer that these will be non-current or current. It depends whether the recoverability is falling within 12 months from the reporting date or not, and that how we will decide basis on when the bids are going to be completed, right? On basis on that. Third one, GST deposited paid under the dispute or the GST payment made under the dispute. So if there are any disputes and until the disputes are resolved, department has asked to deposit certain amount of taxes or GST. Now company has deposited those, and we do not know when the dispute will be resolved. That is when the court order will be passed, right? So at times it happens court order comes in 3 months. Sometimes it takes 3 years, sometimes it takes 10 years, right? We don't know. Then what to do for the preparation of our financial statements? So what we do? Classification of the GST deposited paid to the government authorities in the event of any legal dispute which is under protest would depend on the facts of the case and the expectations of the entity to realize the same within a period of 12 months. In case the entity expects these to be realized within next 12 months, it should be current, otherwise non-current. Now, how it will be decided whether it is realizable within next 12 months or not, right? So we will take the uh, opinion of our lawyer, right? Whoever is, handling this case on our behalf, right? So the lawyer will say that, boss, your case is solid, and there are similar recent rulings, by the High Court or by the other courts in favor of the assessee in these matters, right? So it is most likely that you will win the case in next hearing, or max in next to next hearing. So probably within a 3 months period, the order will come, and then you will be receiving the refund of this deposit, right? Then the company says, because we are there are chances more likely than not that we will win the case, because there are similar recent rulings available in favor of assessing in these situations and cases, and our case is very similar to what has already been concluded in other cases. So drawing the reference of those cases, we can present our case, and it solidifies our position on the winning side, right? And hence we can conclude that in next 3 months or maximum in next 6 months, we will be able to receive the deposit. Then if the company takes this assumption or expectation, then basis on that it will be current. And if the lawyer says, no, your case is kind of 50-50, we don't know what would be the outcome, so let's wait for the court order, right? And if the court order doesn't come by the reporting date, then probably management may believe that it might take more than usual time, might more than 12 months from the reporting date. In that case, it might be possible we will not be able to receive the refund within next 12 months. Hence, let's go and classify it as non-current. So, as such, standard doesn't say there is any thumb rule which we need to agree upon for any of the items, but the conceptually applying our professional skepticism, what is the answer basis on the specific case to case basis or circumstances basis that we need to develop on the basis of some judgment and management assumptions, right? And if those assumptions and judgments sail, then accordingly we can decide upon, right? So in practical life, we have the luxury of doing this analysis by doing multiple rounds of discussions with the clients or with the third party or some other parties. But in the examination hall, we need to decide upon basis on very limited facts available in the question, right? So instead of thinking here and there in the examination, we will strictly focus on what are the facts given in the question, right? Basis on those facts, whatever is the answer, that should be your answer, right? Clear?
Yes, sir.
Okay. Next question. An entity has taken a loan facility from a bank that is to be repaid within a period of 9 months from the end of the reporting period. Prior to the end of the reporting period, the entity and the bank enter into an agreement whereby the existing outstanding loan will unconditionally roll into the new facility, which expires after a period of 5 years. Right? So just read the question carefully again. Let me reread once. An entity has taken a loan facility from a bank that is to be repaid within a 9 months period from the end of the reporting period. First line says to be repaid within 9 months from the reporting date, right? Prior to the end of the reporting period, the entity and the bank entered into an agreement whereby the existing outstanding loan will unconditionally roll into the new facility which expire after a period of 5 years, right? So before 31st March, bank and the company agreed upon to roll over the loan for next 5 years, right? Instead of repaying it within 9 months from the 31st March, right? A. How should such loan be classified in the balance sheet of the entity? Current or non-current?
Yes, sir. Question number A, it will be the non-current. The reason is that they agreed, and its agreement is done. It is unconditional also
Hmm.
for the period of 5 years before the reporting period, which
Hmm.
means we can consider this as a non-current item, sir.
Okay. Will the answer be different if the new facility is agreed upon after the end of the reporting period?
Yes, sir. Since it is extended after the reporting period, we are not sure about that particular item. So hence it will be classified as a current item only.
So you mean to say if the rollover is concluded on or before the year end date, which is assumed to be 31st March, then it will be a non-current because the rollover has already been effective on the year end date. But in case the rollover has not yet been finalized and agreed upon after the 31st March, say on 1st of April, then because on the year end date the rollover was not in place, so it would be current. That's what your answer is.
Yes, sir.
Okay. Third, will the answer to A be different if the existing facility is from one bank and the new facility is from the another bank?
Yes, sir. The my answer will be different for if the existing facility for that bank and the new facility in the different bank. For the existing facility, the item will be classified as a current as per the yeah, correct. And for the new facility, it is a separately is taken for 5 years, which means it's a more than 12 months. In that case, it will be classified as a non-current.
Okay. And the last, will the answer to A be different if the new facility is not yet tied up with the existing bank, but the entity has a potential to refinance the obligation?
Yes, sir. No, sir. It will be classified as a current only. The reason is the new facility is not tied up under the potential refinancing obligation. The entity has the potential to refinance the obligation,
Mhm.
which means that they are not going to extend the facility. So that it will be not classified as a non-current. It will be classified as a current only.
Perfect. So let's see. Answers are correct, but how we are going to present them in our examination? Let's give a read to that as well. The loan is due, not due for the payment at the end of the reporting period. The entity and the bank have agreed with the rollover prior to the year end reporting date for a period of 5 years. Since the entity has unconditional right to defer the payment or settlement of the liability for at least 12 months after the reporting period, the loan should be classified as non-current. So this is the case where we are saying that on or before 31st March, rollover has been unconditionally agreed upon with the bank, and hence company has the unconditional right to defer the settlement, right? So hence the current liability, which otherwise would have been presented as current, now would be presented as non-current because the rollover is already in place, correct? Second, in second case, when the rollover, instead of agreeing upon within the year or on or before 31st March, has agreed upon after the year end, right? So in this case, answer will be different. Yes, the answer will be different because the rollover is agreed upon after the year end of the reporting date. Since the assessment is required to be made based on the terms of the existing loan facility, at the end of the reporting period, the entity does not have the unconditional right to defer the settlement of the liability for at least 12 months after the reporting period. Hence, the loan is to be classified as current. Now, I'm not sure if any of you is getting a doubt that somewhere in your main sessions you must have studied that there are two important dates. For example, let me draw the chart, right? So, for example, this is 31st March 2025, right? This is 30th June 2025, and suppose this is 18th of July 2025, right? And this is the date when the board of directors meeting is conducted and the financials are approved. Okay, right? Now, are you able to recall something from your main classes? So you must have studied that in case the loan covenant is breached, right? And that covenant waiver is obtained by the company on or before the 31st March, right? Then it gives the classification basis on that. If the company fails to obtain the waiver from the bank on or before the year end and takes the waiver on or before the date when the financial statements are approved, still it would be treated as adjusting event, and the current non-current classification will dependent upon whether the waiver is obtained on or before the financials approval date. Yes or no? Are you
Yes,
able to
sir.
recall this discussion?
Yes, sir.
Now, applying the same methodology, has anybody doubted that in the case B here, why this rule is not, we are applying? Why we are sticking to the year end report date only? Why we are not applying the this rule of the covenant breach and the waiver obtained?
Sir, in this case, it is specifically mentioned it is a unconditional right.
No, no. So unconditional to वहां पर भी है. Waiver is obtained unconditional only, right? The only difference is why I'm picking up this topic right now, because many people might get confused that there was something board of date concept was studied, but we have not applied that concept here, right? So why it is so, right? So the two cases are altogether different. So in our current case, whether we are talking about the covenant breach, yes or no?
Sir, it is not the covenant breach. They subsequently
Correct.
they developed some of the situations.
Correct. So it is not a covenant breach. And because there is a no covenant breach, right? It is a normal rollover the company is agreeing upon with the banker, right? So banker uh, approves the rollover, that okay, we are good to go for next 5 years. We are not asking you to make the payment of the loan within next 9 months, but the original due date, which is falling within 9 months from the reporting date, was not on account of any covenant breach, right? So that was the normal due date, right, as per the terms or the tenure of the loan, right? Hence, because there is no covenant breach, so we will simply stick to the unconditional approval obtained on or before the reporting date. But because this concept entirely, revolves or comes into play only when there is a situation where the covenant breach has happened, and because of that covenant breach any long term loan has become payable on demand, right? And because companies saw that we have breached some covenant, because of which our 20-year 10-year loan has now become repayable on demand, right? Hence they approach the bank, right? And banker says, okay, we are okay to give you a waiver of this default or the covenant breach, and we will not ask the payment. And that is that approval is signed, waiver approval is signed and given to the company, right? Now in India, what generally happens, by the year end 31st March, many companies doesn't realize that they have breached any covenant, right? And as and when they start preparing their financial statements and notes to accounts in April and May, and by that time statutory auditors are also starting the audit, then how somehow it comes into light that there is a covenant breach, right, for any loan agreement. And then the company realize that there is a covenant breach, and because of this breach the liability will become payable on demand, and hence it will be presented as current liability instead of the non-current. Then they approach the bank, and bank gives the waiver, right? In that case, to adjust these scenarios, India's 1 as well as India's 10 have taken a carve out from the IFRS, right? So globally, under the IFRS, the board of financials approval date or board of directors meeting date is not relevant. So IFRS says, boss, if there is a covenant breach, you have to take the waiver on or before the year end itself, right? But under India's institute felt that in India, it might be very challenging on the part of the company that they track their covenants so, minusculely, so that they will be able to get these waiver letters from the banker on or before the year end date. And just to, make their life simple, so a carve out has been taken under the India's 1 as well as under India's 10 adjusting events, right? And hence, for the purpose of India's, because of this carve out, the date is extended from the year end to the financials approval date by the approving authority, which is the board of directors in case of a company, right? So that's the concept. So there are two situations. A simple rollover, it is always driven by the normal logic, that is on or before the year end date. A covenant breach and a waiver of that covenant breach, it can go and extend it up to the financial statements approval date. Is that clear now?
Yes, sir.
Right? So two situations are different, right? So we should be very clear in our examination. If the examination question explicitly mentions covenant breach, then you will apply this concept, right? If the examination question doesn't talk about any covenant breach and simply talks about a rollover or the extension, or I would say any other terminology other than the covenant breach, right? Then it will be the normal date. That is the year end reporting date for the classification. Clear?
Clear, sir.
Third one. If the what was the case in the third situation? Will the answer be different if the existing facilities from one bank and the new facilities from the another bank? Now, in this situation, what is happening? Altogether, the bank is changing, right? My existing banker is not doing the rollover. What I am doing, I am settling with this banker and getting the new loan from the new banker, right? So in this case, what will happen? Loan facility arranged with the new bank cannot be treated as the refinancing, as the loan with the earlier bank would have to be settled, which may coincide with the loan facility arranged with the new banker. In this case, the loan has to be repaid within a period of 9 months from the end of the reporting period, and therefore it will be current liability. Correct? Because with my existing banker, I am not getting any rollover agreed. If I am not getting any rollover agreed, it means it has to be settled within next 9 months from the reporting date, irrespective of the fact that I am settling it by way of taking a loan from another bank. That doesn't matter. That is a future transaction. But my original obligation is within 9 months from the reporting date, and hence it will be a current. Clear?
Yes, sir.
And the last, what was the last situation? Will the answer to it be different if a new facility is not yet tied up with the existing bank, but the entity has the potential to refinance? Again, what will happen? It will be a current only. Why? Because company is planning or having the potential to refinance, right? So that is a future course of action. Whether it happens or not doesn't matter, right? As on 31st March, I have the obligation which needs to be settled within next 9 months. Correct? Clear?
Yes, sir. Clear, sir.
Perfect. Let's do this one. In December 2001, an entity entered into a loan agreement with a bank. The loan is repayable in three equal installments starting from December 2005. One of the loan covenants that an amount equivalent to the loan amount should be contributed by the promoters on 24th of March 2002, failing which the loan becomes payable on the demand. As on 24th March 2002, the entity has not been able to get a promoter's contribution. On 25th March 2002, the entity approached the bank and obtained a grace period of up to 30th June 2002 to get the promoter's contribution. Right? So there is a loan agreement with a bank where the condition is that promoter contribution should also be received by the 24th March. Entity believes they may not be able to get it by 24th March, hence they agreed upon to get it by 30th June, right, with the banker with a grace period. The bank cannot demand immediate repayment during the grace period. The annual reporting period ends on 31st March 2002. As on 31st March 2002, how should the entity classify the loan?
Yes, sir. Since they agreed with the bank, the promoter contribution can be extended up to 30th June. It will be classified as a current only.
Why? Why current? In spite of the extension?
The original, okay, the loan is repayable in three annual equal installment from 2025.
Hmm.
Yes, sir. It
Because
will
the
be non.
extension is for 3 months only now. See, whenever we say any liability is the non-current, only when we have the settlement obligation after the 12 months from the reporting date. But in this case, what is happening? My year end date is 31st March, correct?
Yes, sir.
And I'm getting the extension up to how which date? 30th June only. So it is 3 months only. Yes or no?
Yes, sir.
So because I have, in spite of having the extension or the grace period agreed upon, I have the obligation within next 3 months only, right? And by virtue of not having the 12 months, minimum 12 months from the reporting date, it will be the current, correct? So paragraph 75 of NDS 1 inter alia provides that an entity classifies the liability as non-current if the lender agreed by the end of the reporting period to provide a period of grace period at least 12 months from the reporting period, right? Within which the entity can rectify or breach and during which the lender cannot demand the immediate payment. In the present case, following the default, grace period within the which the entity can rectify the breach is less than 12 months, right? Because the grace period itself is less than 12 months from the reporting date, and hence the liability will be current only.
Sir,
Clear?
here, okay, sir. Here, in the first two line of the question, in December 2001, an entity entered in the loan agreement with a bank. The loan is repayable in three equal annual installments starting from December 2005.
Hmm.
Is there any relevance on this question, sir?
No, so okay, so whenever the loans are repayable in installments, right? So how do we present those loans? Do we present all the amount of loans as current or non-current, or do we present the current to that portion of the loan which is repayable within next 12 months from the reporting date and remaining non-current?
Whatever the loan which is less than 12 months, that loan alone we will present as a current, otherwise we will present as a non-current.
Correct. So in the question, it is mentioned that it is equally payable within next three installments, right? So one installment is payable within next 12 months. right? And remaining two installments after next 12 months, right?
Okay, which means the annual installment is the less than 12 months. It will be
Correct.
always classified as a current.
Current. Correct. That's what we
Okay.
do always, right? Even under the IGAP. Okay, second scenario. Assume that in anticipation that it may not be able to get the promoter's contribution by the due date in February 2002, the entity approached the bank and got the compliance date extended up to 30th June 2002 for getting the promoter's contribution. In this case, will the loan classification as on 31st March 2002 will be different from the above? So Ind AS 1 says that classification of liability as a current or non-current will be decided in case of the breach of the loan covenant and does not deal with the classification in case of the expectation of the breach. Right? What do you mean by this? So, Ind AS 1 says, boss, we talk about the current non-current classification of a loan when the breach has already happened rather than the expected breach in future. Right? So, what is happening in this scenario? In this scenario, breach has not yet happened. Breach date, which was ideally 24th March, right? So by 24th March, if the promoter fails, then the breach would have happened. But in the second scenario, what the company is doing, they are saying that let's not consider the 24th March as that date. Let's consider 30th June as the date to assess whether the breach has happened or not. Now, because 30th June is falling after the year end, that is the 31st March, right? So breach is not happening on or before the year end. And because the breach is not happening on or before the year end, so there is no issues at all, right? Breach will happen or not, that will be known to us when we uh, reach 30th June, and which falls in the next financial year, right? So there is no issue with the existing current financial year, so nothing to worry about. The liability will continue to be presented as non-current. Clear?
Yes, sir. Clear, sir.
Perfect. Okay. An entity manufactures passenger vehicles. The time between purchasing of underlying raw materials to manufacture the passenger vehicles and the date the entity completes the production and delivers to its customers is 11 months. Customer settles the dues after the period of 8 months from the date of the sale. Scenario A. Will the inventory and the trade receivable be presented as current in the balance sheet? Just think through, reread the fact, think through.
Yes, sir. It will be classified as a current nature
Okay. Why?
because it is within the operating cycle.
What do you mean by the operating cycle?
Operating cycle means is purchase period and the production period and the collection period. We will add all together, then it will be treated as a operating cycle.
So you mean cash date from which the cash is deployed until the date when the cash is received.
Yes, sir.
Correct? So that is
Yes.
the operating cycle. So normal operating cycle means the company's whole bunch of activities starting from the deployment of the cash until the returning of the cash to the company, right? So this is the period which we usually say normal operating cycle, and this constitutes largely three activities: purchase of raw material, production, and realization of the debtors after the sales. Correct?
Yes, yes, sir.
So in this case, the time lag between the purchase of the inventory and the realization into the cash is 19 months. That is 11 months plus 8 months. Both the inventory and the debtor would be classified as current if the entity expects to realize these assets in its normal operating cycle. No, so by any chance, 19 months, which is more than 12 months, shouldn't sound, non-current. So 19 months is more than 12 months, yes or no? Yes, right? So why we are calling it as current then?
Sir, as per the Ind AS 1, it's based on the operating cycle. What is the period is there? Then, if any item is within that operating cycle, it is be classified as a current item. And
Okay.
also, it record to presentation will be done. What is a due within the 12 months? What is a due more than 12 months? That will be the separate part.
So that's right. So if the company's operating cycle is more than 12 months, right, then the current non-current classification will happen basis on the operating cycle, right? Any idea which industries can fall into this?
So, as an example, the manufacturing company majority will come. Say, one of the example, the paper machine manufacturing company, it
Mhm.
actually from the procurement of the raw material up to the finished stage, it will take some of the machine take 2 years also,
Hmm.
because that involve a lot of technology and importing the raw material from the various site and the clearance of that certification, quality check, everything it will comprise more than 12 months.
Right. So also the construction companies can also have the larger normal operating cycles as compared to the 12 months period.
Yes, sir. That construction company is the right. It's easy to remember because construction will take more than 12 months.
Yeah.
But my
Right.
example, it's very rare case that manufacturing activity.
No
But
worries.
I was into that one of the client actually. There is a paper manufacturing machine.
Hmm.
That is I could remember that.
Yes. Assuming the production time was say 15 months and the time lag between the date of the sale and the collection from the customer is 13 months, would your answer be different?
No, sir. The reason is that we already fixed that the operating cycle is
Correct.
19 months. Here only that there are 15 months is between the collection and 13 months. It's within that limit only.
Correct. So it doesn't matter when we already bypassing the rule of 12 months, right? So we are no more focused on the 12-month period. We are more focused precisely on the determination of the operating cycle. And if the operating cycle determined to be say 28 months, then again the same rule applies, right? It is not dependent anymore on the number of months as soon as we are migrating from the 12-month rule to the operating cycle rule, correct?
Yes, sir.
One more example, I was thinking through the wines business. Wines companies can also fall into this.
Yes, sir. It's a maturation. They will
Yeah,
put in that 5 years old, 10 years, 20 years like that.
correct, perfect. XYZ Limited, the company, is into the manufacturing of the tractor parts and mainly supplying components to the OEM companies, original equipment manufacturer. The company does not have any subsidiary, joint venture, or associate company during the preparation of the financial statements for the year ended 31st March 2001. The accounts department is not sure about the treatment or the presentation of the below items or below matters, and the accounts department approaches you uh, and wants your professional advice as a chartered accountant how to treat below matters while preparing the financial statements, right? Number one, there are certain qualifications made by the statutory auditors in the audit report of the company with reference to two indices. Now, what will your advice be? How to deal with these qualifications?
Sorry. For my network was issue in last 1 minute, but I could not.
Okay. So what I was saying, that company is preparing the financial statements and the accountant at the company is not sure how to deal with these matters. So as a expert, the company is approaching you because you are a chartered accountant to take your opinion how to deal with these matters while preparing the financial statements. The first matter is statutory auditors have given certain qualifications in their audit report, how those qualifications needs to be dealt with by the company. And then because company is preparing uh, standalone financials, then accountant wants to know whether the standalone word is mandatory to write at the top of the financial statements. That is standalone balance sheet, standalone statement of profit and loss account, standalone statement of changes in equity, standalone statement of cash flows. So the word standalone, is it mandatory to write or we can simply avoid? Then third matter, the company is an Indian company and preparing and presenting its financial statements in, INR. Is it necessary to write in the financial statements that the company financial statements are presented in particular currency, say INR, whether the name of the currency, the presentation currency is mandatory to be mentioned or not? And the fourth, the company had a sales transaction with 10 related parties during the previous year. However, during the current year, there are no transactions with the 4 related parties out of the aforesaid 10 parties. Hence, the company is of the view that it need not disclose the sale transaction with these 4 parties in the RPT disclosures. So, these are the 4 key matters. So, in the first case, when the auditors qualifying the audit report, right? That company has not complied with two Ind ASs, right? So that is the auditor's opinion, right? So they are qualifying their audit report. But what impact we need to take in our financial statements? Nothing. So in the financial statements, entity whose financial statements are complying with the NDS shall continue to make an explicit and unreserved statement for such compliance in the notes. An entity shall not describe financial statements as complying with the NDS unless they comply with all the requirements of the NDS. Right now, because auditors are qualifying the financial statements are not complied with two Ind ASs, then company needs to take the adjustment, right? What is the non-compliance? They need to correct the non-compliance. Otherwise, the auditor's report will continue to be qualified, right? That's all. Nothing else company needs to do.
Yes, sir. Because of that non-compliance, is the management is not rectified in the financial statement. That is a reason the auditor has given the qualification. And
Correct.
the qualification, if they corrected, the auditor will not issue the report.
Correct. So there are only two choices. Either company corrects as the auditors are advising and they will get the qualification dropped. If the management does not agree to auditors stand and auditors does not agree to the management stand, then management will continue to give a unreserved and explicit statement of the compliance with India's and audit report will continue to be qualifying that, right? No harm. Second, standalone word. What to do? Do we need to mention everywhere? No, but needs to disclose that the financial statements that these are the individual financial statements, right? So word standalone is not mandatory, but management needs to disclose that these are not consolidated, but these are individual financial statements, right? So instead of using the standalone word, individual financial statements can be mentioned. Currency. Do I need to disclose the currency? Yes. Which standard? India's 21. Prominently ask for it. under India's 21, you must have studied there are three types of currencies: the functional
Yes, sir.
currency, the foreign currency, and the presentation currency. Correct?
Yes, sir.
Now, whenever we are preparing the financial statements in any currency, do we need to mention that which currency we are presenting our financial statements in? Yes. That is the requirement of the India's 1 as well as India's 21. So, two standards are requiring this. Hence, it is mandatory to disclose in which currency you are preparing the financial statements. Right? And the last, RPT disclosure. So, what is the issue? Issue is there are all in all 10 related parties with whom the company had the related party transactions in the last year. But out of those, with 4 parties, there are no more transactions in the current year. Right? Now, company says because there are no transactions with those 4 parties in the current year, hence, for those 4 parties, prior year numbers are also not required to be disclosed. Is that correct?
No, sir. For the related party relationship and relation party, there is two situation. There is a related party relationship. That is one. That portion also we will report that disclose. And also when there is a related party relationship and the transaction also for that item also we need to disclose it.
The question here is, I agree your point, but the question here is, if I do not have the transaction with 4 related parties in the current year, while I had the transaction with those related parties in the previous year, do I need to disclose those related parties in my RPT disclosure saying that current year amounts nil, previous year amounts XXX?
Previous amount, when there is a previous transaction is exists, then we have to put current year transaction XSS. If both year there is no transaction, then there is no need to disclose it.
Perfect, perfect. If both the years there are no transactions, then we can eliminate. Otherwise, we need to disclose. Correct?
Even there is a current year transaction also, it has to be reported.
Yes. Right.
Either year, current year or earlier year.
Right. Perfect. Question number 6. A company presents financial results for the 3 years, one for current year and two comparative years. Right? So what company is doing? Instead of regular presentation of the 2 columns, they are presenting how many? 3 columns. One for the current year and 2 preceding years. Initially, for the purpose of the management information every year, in addition to the general purpose financial statement, the aforesaid financial statements results are presented without furnishing the related notes because they are not required by the management for the internal purpose. During the current year, management thought, why not they should present the third balance sheet and or third statement of P&L in the general purpose financial statements also. It will save time and will be available easily as and when the management finds need in the future. With reference to the above background, answer the following. Can the management present the third statement of P&L as an additional comparative line item in the general purpose financial statement? What do you think? Yes or no?
No, sir. That P&L and balance sheet is not needed always. Only the current year and the previous
No,
year.
no, 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 no. It's not
Uh,
about needed. It's about company wants to present whether the company present or not.
there is no prohibition on that. The company if wishes they can present it. But however, the standard is very specifically saying that only the third balance sheet when there is needed, when there is a prior period error or fraud, only
Mhm.
those item only we will the opening balance sheet we will incorporate.
So that's why at the beginning of the session, I told or I said that these theoretical standards are very important, right? Because whatever the general belief we have, sometimes, are wrong, right? As per the para 38C of India's 1, an entity may present comparative information in addition to the minimum comparative financial information required by the NDS. Right? So that is the minimum information that current year and the one comparative year, that is the minimum. But over and above, can I present something additional? Yes. 38C, para 38C of India's 1 allows to present additional columns for any other preceding years in case management wants to present, as long as the information is presented in accordance with the Ind AS. So the third column should also be complied with all the Ind ASs. The comparative information may consist of one or more statements preferred to in paragraph 10, but need not comprise a complete set of financial statements. When in this case, the entity shall present the related note information for those additional statements. Right? So there is no prohibition by the standard which restrict you to present the third balance sheet or the third P&L or the third column for the cash flow, right? You can go ahead and present provided you are complying with the Ind AS requirements if you are presenting something. Clear? If the management present a third statement of profit and loss in the general purpose financial statement as comparative, is it necessary that it should be complied with the Ind AS? Yes, that's what the para 38C says, that it has to be complied with the Ind AS. Correct?
Yes, sir. If they voluntary, they are you providing third or fourth balance sheet or the profit and loss account, they have to comply the Ind AS.
Correct. So there are two things. Number one, is there any requirement to present the third column for the P&L cash flow balance sheet? No, there is no general requirement. You can continue with the minimum requirement. Minimum requirement is to present for 2 years, one for the current, one for the preceding, right? Then there is a top-up requirement to present the third balance sheet casted by Ind AS 8 as well as Ind AS 1 as and when there are any reinstatement of the prior period error correction or change in accounting policy. So in that case, only the balance sheet third column is required, right? That is mandatory if that is the situation. On the top of it, if you want to present any third balance sheet or any third P&L or any third cash flow, can you do so? Yes. As per para 38C, it is allowed. It is not prohibited to give additional columns, provided you are complied with the Ind AS for that additional column as well. Clear?
Yes, sir.
Third one, can the management present the third statement of P&L only as an additional comparative in the general purpose financial statements without furnishing other components like balance sheet, statement of cash flow, or statement of changes in equity of the financial statements? Yes. So it is not mandatory that if you are showcasing only P&L as an additional, then you have to present the balance sheet and the statement of changes in equity or the cash flow as well. It is all at your wish for which statement you want to add third column if it is a voluntary presentation. Clear?
Okay. I thought that it has to be complete set of financial statement has to be present there.
So there are certain beliefs which we have in our mind, and there are certain facts which are there in the standard, right? So we shouldn't be belief driven, right? Whatever the standard is saying, that is the law. Clear?
Yeah, now it is understood that it's any
Yeah.
component they can provide.
Yeah. So any additional column for any of the statement, if the management is presenting voluntarily, they can do so provided they are complied with the index, and there is no requirement that if you are presenting third column for the P&L, then you need to present third column for all other statements as well. It is all your voluntary presentation, right?
Yes, sir.
Perfect. So I think your break time is about to start. So let's have a 15 minutes break and we will be resuming back at 8:40. Break started. Okay. I hope everybody is back and we can start. Thank you. So now the next standard is India's 34 interim financial reporting. So when we prepare quarterly results for any company, right? Or half yearly results or half yearly balance sheet, right? Uh, for any company, listed companies used to prepare, quarterly results and publish them, right? So which standard we need to follow for preparation of those results? India's 34 interim financial reporting, right? And how it is different from the India's one? Any guesses?
Sir, what is the question, sir?
How India's 34 interim financial reporting is different from India's one presentation of financial statements.
Yes, sir. In that presentation of financial statement,
Hmm?
when they are choosing the complete set of financial reporting, then that Ind AS 1 is applicable. It is on the option only.
Okay. So India's 34 says that interim financial reporting. What do you mean by the interim financial reporting? What are the minimum components of the interim financial report? So it shall include a minimum condensed balance sheet, condensed P&L, condensed statement of changes in equity, condensed cash flow, and selected explanatory notes, right? So that's what India's 34 says. While India's one says a balance sheet, a statement of profit and loss, a statement of cash flow, a statement of changes in equity, and the explanatory notes to accounts, right? And India's 34 says condense, 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 and for the explanatory notes to accounts, it says selected explanatory notes. Means not all the notes are required to be given, right? So that is the basic difference between the requirements of India's 1 and India's 34. So India's 1 says everything needs to be complete, and India's 34 says minimum condensed information is required, right? It's not about all the things you need to give, but a basic minimum requirement they have stipulated which we need to give while preparing the condensed financial statements in accordance with India's 34. And same rule applies for the notes to accounts as well. So in India's one, we will give all the notes to accounts required by all the India's. Under India's 34, we will give only selected explanatory notes rather than giving all the notes. Is that clear?
Yes, sir.
Right. Now, India's 34 does not prohibit or discourage an entity from including in the condensed interim financial statements more than the minimum line items. Again, the same thing. Like India's one says that if you want to do any additional presentation voluntarily, you can do so. India's 34 also says the same thing. India's 34 says while preparing the condensed financial statements, if you want to give anything additional over and above the minimum line item requirement, you can do so. Clear? What is the form and content of India's 34 financials? So India's one says complete set of financial statements, right? So everything will be condensed. It will not be complete. Okay. Then India's 34 says you must have studied in your main session, main classes, that it requires you to disclose significant events and the transactions occurred during the interim period. Yes or no? Yes. What do you mean by the significant events and the transactions? Any examples? For example, writing down of the inventories, reversal of the impairment losses, reversal of any restructuring provisions, acquisition or disposal of any property, plant, and equipment, commitments given to the vendor for purchase of property, plant, and equipment, litigation settlements, court order codes received for the pending litigations, correction of prior period errors, changes in business economic circumstances that led to the significant change in fair value of company's financial assets and financial liabilities, right? All these matters are significant event and transactions. So these are some of the examples. There could be many more, right? So we need to decide basis on our professional skepticism what is significant, what is not, and if something we decide upon and agree upon is something significant, then as per India's 34, that becomes obligatory on our part to report that in the form of disclosures or explanatory notes on the financial statements for the interim period, right? Because these events or transactions belong to that interim period. Clear? Right? Then what the standard additionally says, if there is a revenue or income or expense, right, occurred in a particular quarter, then that should be reported or recorded and reported in that quarter itself, or we can suspend the recording to the next quarter or the year end as well. What do you think? Can we do the teaming and lading with the revenue or income items? Yes or no? No, correct? So what we need to do, whatever belongs to a particular interim period or a quarter or a half year, that has to be recorded and reported in that quarter as income or expense, right? We cannot postpone it, or we cannot do the recording of any expected revenue to be received in the next quarter in the current quarter, because if we do these practices, then we can play with our interim results. If we want to showcase the top line higher, we will prepone the revenue of the next quarter to the current quarter, and we will report the higher revenue for the current quarter. Or if we have expectation of low revenue in the next quarter, we can postpone certain revenue from the current quarter to the next quarter, right? So that will all be play in our hands. So that's why India's 34 specifically cast this responsibility, or raises this expectation that whatever belongs to a particular quarter or the interim period should have been recorded and reported in that very quarter itself. We cannot do any teaming lading with any of the income or expense items. Is that clear? Right? Okay. Suppose in a particular year, for example, if you are preparing the financial statements for say 30th June 2025 quarter, right? And you come to know that there was an error in the previous year, March 2025 financial statements, right? And the error was pertaining to the say quarter three of that year, right? And now you are preparing for the quarter one results for the next year. So what do you think? Do you need to correct that error in the Q1 itself, or you can postpone it until the preparation of the year end financials? Because generally errors are corrected on the year end financial statements, and this is not a requirement for the quarterly results. What do you believe? So will you correct the error in the quarterly results, or you will say that I will correct this error while preparing the annual financial statements only? That's the question. Quarterly, correct. So Ind AS 34 is nowhere different in terms of the recognition and measurement requirements, right? From Ind AS 1. So, like Ind AS 1 is applicable on the complete financial statements for the annual period or the full period, similarly, Ind AS 34 becomes applicable for the interim period financial statements, and all the rules for the recognition and measurement are mutandis, right? So how we are doing it in our year-end financial statements, we are doing the same thing in our interim financial statements, right? Neither we can prepone or postpone any income recognition or expense recognition, nor we can escape on any of the error correction or taking the effect of any change in accounting policy or reinstatement in the quarter if it is clearly evident that it needs to be done. Clear? So with that note, let's start with the questions. So this was the brief background of Ind AS 34 I thought to give you before we start with the question answer. So let's do fixed production overheads. For the financial year is 10,000. Normal expected production for the year after considering the planned maintenance and the normal breakdown, also considering the future demand of the product, is 2000 metric ton. It is considered that there are no quarterly or seasonal variations. Therefore, the normal expected production for each quarter is 500 metric ton and the fixed production overhead for the quarter is 2500. Now, in the first quarter, 400 is the quantity of actual production. Second quarter actual production 600. Third quarter actual production 500. Fourth quarter actual production 400. Total production for the year is 1900. Presuming that there are no quarterly or seasonal variation, calculate the allocation of the fixed overheads, production overheads for all the 4 quarters in accordance with Ind AS 34 and Ind AS 2. Will the quarterly results affect the annual results? Would you want to give it a try before I discuss the solution? So you just need to tell me how much allocation of fixed overheads you will be doing in each of the quarters and how much amount you will be charging to the P&L in each of the quarter, right? So there are two components you need to tell me. One, overhead allocation, right, for each quarter, and expense to P&L for each quarter, right? This is you need to tell me. So you need to tell me the amounts for both these items for each of the quarter. So I'm just waiting for couple of minutes for you to respond. This is a very simple calculation, nothing much to be done. With the answer. For the first quarter, how much would be the actual production of overheads? 2500. Fixed production overheads based on the allocation of rupees 5 per unit allocated to 400 units to 2000, and 500 will be charged to the P&L unallocated. Correct? So how this is calculated? 400 is the actual production, 500 was the expected production. So basis on the expected normal course of production, we compute the charge rate. So charge rate is 5 rupees per unit because we produce lesser as compared to the normal, only 400. So 400 into my 5, 2000. 2000 will be the allocation, and remaining portion of 500 would go to P&L, right? This is what we do under Ind AS 2, correct? Clear? Overhead allocation question you must have practiced under Ind AS 2, right? It is always done basis on the normal capacity or the normal expected production units, right? And then once the charge rate is computed, that is multiplied on the actual production. Yes or no? Then what would be the amount for second quarter? So until the second quarter, actual production overheads on the year to date basis would be 5,000, 2,500 for the Q1, 2,500 for the Q2. So cumulative amount would be 5,000. Now, fixed production overheads to be absorbed on year to date basis is 1,000 into my 5,000. Why? Because 400 units were produced in the Q1 and 600 units are produced in the Q2. So total is 1,000, right? So 1,000 cumulative units and cumulative amount is 5,000. So 5 rupees is adjusted. So there is nothing left to be credited to the P&L. Now what will happen? In the second quarter, 500 are reversed by way of a credit to the statement of the P&L for the second quarter. Why? Because in the Q1, when we were producing less, 500 was charged to the P&L, right? And in the second quarter, this will be reversed because now in the second quarter, we have achieved the desired actual production of 1,000 units. Clear? Yes, no? Perfect. Then for the third quarter, what is the cumulative production? 7,500, right? And fixed production overheads to be allocated on year to date basis would be 1,500 into my 5 is equal to 7,500. Why? Because in the Q3 we are producing only 500 units. So 1,000 plus 500, 1,500 are the units of the actual production. 5 rupees is the charge rate. So 7,500 is the allocation and 7,500 is the amount available. So there is neither under recovery nor over recovery. So nothing further required to be charged off in the P&L, right? And in the fourth quarter, total production overhead amount becomes 10,000 and we have again produced 400 units. So total units are 1,500 plus 400, 1,900 into my 5, 9,500. Then 500 will be again charged to the P&L because it is a under recovery. Correct? So by doing this numerical, what principle we have learned? The principle is for each quarter we have to give a equal importance, right? So we are producing the results for each quarter, keeping in mind that this is the period for which the revenues are earned and expenses are incurred and profitability is arrived. So in order to give the true picture of the P&L of the quarter, we need to record the expenses for that quarter itself, right? Instead of adjusting it on any assumption that what would be the picture at the year end, right? So whatever is the result on each quarter, that has to be given effect. Any doubts on this? Perfect. Thanks, Samanathan. Okay, let's do this one. Narayan Limited provides you the following information and asks you to calculate the tax expense for each quarter. Now, what you need to do? You need to calculate the tax expense. Assuming that there is no difference between the estimated taxable income and the estimated accounting income, estimated gross annual income is 33 lakhs and including estimated capital gains of rupees 8 lakhs. So 33 lakh contains 8 lakh capital gains, right? Estimated income over the Q1 is 7 lakh, Q2 8 lakh, including the estimated capital gains, and uh, Q3 12 lakh and Q4 6 lakh, right? So this is how the split is given for each quarter income. Tax rates on capital gains 12%, on other income first 5 lakh 30%, balance income 40%. Now basis on these tax rates and these quarterly income levels given, can you compute the tax amount for each quarter you are going to present in your P&L? I'm giving you 5 minutes for this. Please try once. Weighted average annual income tax rate is 38%. Okay. So what is the amount for each of the quarters in terms of the tax amount? Q1, you are saying 266, 7 lakh into me, 38%. Okay. What about Q2, Q3, Q4? Q2, you are saying 3 lakh 4,000. Okay. Q3, Q4, Q3 to 48. Okay. Okay. Let's see. So first of all, what we will do? As per the para 30C of the India's 34 interim financial reporting, income tax expense is recognized in each interim period based on the best estimate of the weighted average annual income tax rate, right? So first of all, we need to calculate the weighted income tax rate, right? And then we will apply that weighted rate for each of the quarter. If different income rates apply to different categories of income, such as capital gains or other income earned in particular industries, to the extent practicable, a separate rate is applied to each individual category of the item, right? Now, total annual income exclusive of estimated capital gain would be 25 lakhs plus 8 lakh is the capital gain. So 33 lakh is the total income for the full year. So on 25 lakh, first 5 lakh, 30% rate, 1 lakh 50,000. Remaining 20 lakh, 8 lakh 40 at 40%. So 9 lakh 50,000 is the total tax. So 9 lakh 50,000 divided by 25 lakhs. So 38% is the weighted average of income tax rate for the year, right? Now, we will calculate for each of the quarter. So quarter one income is 7 lakh into my 38%, 2 lakh 66,000. Quarter two income is 8 lakh into my 38%, 3 lakh 4,000. Quarter three, 12 lakh minus 8 lakh into my 38% and 8 lakh into my 12% because there is a specific capital gain tax rate at the 12%, right? So 1 lakh 50,000 to 2,000 plus 96,000, 2 lakh 48,000, and the quarter four, 6 lakh into my 38%, 2 lakh 28,000. Total tax is 10 lakh 46,000. Is your answer matching for all the quarters? Perfect. So you have nailed this concept. So this is how we are going to calculate the income tax expense for each of the quarter while producing the quarterly results, right? Any questions, doubts on this from anybody? Okay, let's do this one. An entity reports quarterly earns of rupees 1,50,000 pre-tax profit in the first quarter, but expects to incur losses of rupees 50,000 in each of the three remaining quarters. The entity operates in a jurisdiction which its estimated average annual income tax rate is 30%. The management believes that since the entity has zero income for the year, how 1,50,000 in the quarter one, and then minus 50, minus 50, minus 50 in remaining quarters, right? Right. So the annual income is zero. So its tax expense will also be zero. What do you think? Whether the management's views is correct or not? If not, then calculate the tax expense for each quarter. What do you think? Annual income is zero, but Q1 income is 1,50,000. Remaining three quarters are negative 50,000. And because annual income is zero, management says, boss, we don't have any tax liability and hence tax expense is zero for all the quarters. What do you think? Okay, so you are saying management is not correct. Okay, then what would be the correct position? Can you tell me the tax expense for each of the quarters? So Q1 will be 45,000. Okay. Q2 would be minus 15,000. Okay. Like that for Q3, Q4. Okay. Let's see. As illustrated in para 30C of Ind AS 34, income tax expense is recognized in each interim period based on the best estimate of the weighted average annual income tax rate expected for the full financial year, right? So this is the para 30C of Ind AS 34. Accordingly, the management contention, since the net income for the year will be zero, no income tax expense shall be charged on a quarterly in the interim financial report, is not correct. Since the effective tax rate or average annual income tax rate is already given in the question at 30%, the income tax expense will be recognized in each interim quarter based on the rate only. The following table shows the correct income tax expense to be reported for each of the quarter. So year one, 1,50,000 income, effective tax rate 30, 45,000. And for the remaining three quarters, it would be a tax refund of 15,000 each. And then in annual, we will say tax expense is zero in the annual financial statements, right? But we cannot say because annual is zero. So in the quarterly, it is all zero, zero. So that is not correct, right? Because each quarter has its own period, own calculation of income and expense, and hence the tax expense as well, right? Clear? Anybody, any questions? Okay, let's do this one. An entity accounting year ends is 31st December, but its tax year ends at 31st March. So accounting year, that is the financial statements are being prepared for the January to December, but income tax assessment or income tax year is 1st April to 31st March. The entity publishes an interim financial report for each quarter of the year end 31st December 2019. The entity's profit before the tax is steady at 10,000 each quarter, and the estimated effective tax rate is 25% for the year ended 31st March 2019 and 30% for the year ended 31st March 2020, right? So for March 19, the tax rate is 25%, and for the year end 20, the tax rate is 30%, right? That's what the question says. Now, you need to calculate the tax expense for each quarter, right? Which quarters? 31/3/19, then June 19, then September 19, and then December 19, right? So for each of these quarters, you need to calculate the tax expense. So just try it once at your end, giving you 5 minutes. So 10,000 is the income in each of the quarters given in the question. For each of the quarter, you need to calculate the tax amount, tax expense. So just try it once. So Q1 you are saying 2,500, Q2 you are saying 3,000, okay. Q3 with 3,000, okay. Q4 with 3,000, okay. Let's see. So for each of the quarter, how much the profit before tax is? 10,000, 10,000, 10,000, 10,000, right? And the total is 40,000. Now, for each quarter, I will apply the tax rate applicable for that year, right? So, for 31st March financial year, for 31st March 19 year, the tax rate is 25%, right? And for the financial year ending with 31st March 2020, the tax rate is 30%. So, 25%, 7,500. And for all the remaining is 3,000, and the income after tax is 7,000. Since the entity's accounting year is not same as the tax year, more than one rate might apply during the accounting year. Accordingly, the entity should apply the effective tax rate for each interim period to the pre-tax result for that period. Now, by doing this question, what is the principle we have learned? What is the learning from this question? What is the learning? So the learning is that we need to apply the appropriate tax rate applicable for that very financial year, right? Basis on the tax pronouncements in the budgets, right? So whatever the tax rate is applicable for the financial year, that needs to be considered for the quarter falling within that financial year, right? And it shouldn't be that whatever the tax rate we had applied for the preceding year, we can continue to apply that for the upcoming quarters which are sitting in the next financial year, right? So the financial year uh, in which the quarter is falling, for that financial year, what is the tax rate by the budget or finance act, that will be applied, right? So this is the learning. Clear? Perfect. Next question. EQR Limited is preparing its interim financial statements for the quarter 3 of the year. How the following transactions and events should be dealt with while preparing the interim financials. Number one, it makes employer contributions to the government sponsored insurance funds that are assessed on an annual basis during the quarter one and quarter two. Large amounts of the payments for this contribution were made, while during the quarter three, minor payments were made. Since the contribution is made up to a certain maximum level of earnings per employee, and hence for higher income employees, the maximum income reaches before the year end, right? So there is a long story given in this question. So what is the conclusion? What the fact is? The fact is that company is making some contributions for some government spotted in sponsored insurance funds for all of its employees for each of the quarter, and it says because they are making larger amounts in the current quarter, so they will be some paying lesser contributions in the later quarters. Now, the entity intends to incur major another item. So, item number one, item number two. The entity intends to incur major repair and renovation expense for the office building. For this purpose, it has started seeking quotations from the vendors. It has also tentatively identified a vendor and expected cost that will be incurred for this work. Right? Second matter. Third matter. The company has a practice of declaring 10% bonus on its annual operating profits every year. It has a history of doing so. Right? Now, while preparing the interim financial statements for a particular quarter or for a particular period, how these three items will be dealt. That is the management looking up for an answer from you as a chartered accountant. So, what are your viewpoints on all the three items? What is your advice to the client? So, I'm giving you 5 minutes. Think through and then let me know. Okay, for the item one, you are saying entity should calculate the average effective contribution rate and accordingly account for each interim period. Okay, what would be the answer for two and three? Future expenses not to be recorded in the current quarter. Okay, so you are saying because company is planning to incur some renovation expense in the future, so those will not be recorded in the current quarter. So you mean to say they will be recorded as and when they are incurred, right? That's what you mean. So you are not going to record any provisions, right, for that. Okay. What is the answer for third? Third, you are saying we need to follow India's 19. That's fine. But we cannot advise to the client that we need to follow India's 19. What is our advice? What is what you will do? What is the final outcome? So you are saying need to make the payment as and when declared and approved. Of course, payment will be made once declared and approved. but I'm talking about the expense, whether you are going to record any expense in the interim financial year or not. Or you will say that when, as and when the bonus is declared, then only expense will be recorded. I'm not talking about the payment. Payment can happen anytime, right? What about the expense in the P&L? When the bonus expense will be recorded? Only in the annual financial. So you are saying bonus expense will not be recorded in the interim financial period, and it will be recorded in the annual financial statement only as and when declared and approved, right? That's what your take is. So no expense in the current quarter or interim. Okay, let's see. Paragraph 28 of India's 34 interim financial reporting states that an entity shall apply the same accounting recognition and measurement principles in the interim financial statements as are applied in its annual financial statements. Right? As I previously mentioned, India's 34 is nowhere different in terms of recognition and measurement what we do in India's one for the annual financial, right? So recognition measurement principles are same. Further, as per paragraph 32 and 33 of the India's 34 interim financial reporting, state that for assets, the same test of future economic benefits apply at the interim dates and at the end of the financial year. Cost that by their nature would not qualify as assets at the financial year end would not qualify at the interim dates either. Similarly, a liability at the end of the interim period reporting period must represent a existing or present obligation at that date, just as in the case of annual financial statements or annual reporting period. What do you mean by existing obligation? Are you able to recall something which you might have discussed under India's 37 provisions? You must have heard present obligation, correct? So for liabilities to be recorded and reported, existing obligation is a criteria, right? Obligation should be present. Now, an essential characteristics of the income and revenue and the expense is that the related inflows and outflows of the assets and liabilities have already taken place. If those inflows or outflows have taken place, the related revenue or expense are recognized, otherwise not. The conceptual framework does not allow the recognition of items in the balance sheet which do not meet the definition of the asset and liabilities, right? So this is all the basic guidance which we all know, and we have been knowing this since ages. Now, considering the above guidance, while preparing the interim financials, the transactions and the events of the given case should be dealt with as follows. If employer contributions to the government sponsored insurance funds are assessed on an annual basis, the employer's related expense is recognized using the estimated average annual effective contribution rate. Oh, very long word. So management need to estimate an average annual effective contribution rate. And basis on that, the quarterly or the interim financial period expense will be calculated and recorded in the interim financial statements, even though the large portion of the payments have already been made in the early in the financial year. So suppose what is the issue here? The issue is suppose the total year end expense is 10,000, right? So instead of 2,500 installments in each quarter happening, how it is happening? Suppose in Q1 it is happening, say 3,000, Q2 it is happening, say 2,800, right? Q3 it is happening, say 2,600, and then Q2, Q4 it is happening the remaining, right? So this is how the payment is happening, right? So in the earlier quarters, excess payments are happening, and in the later quarters, relatively lesser payments will be happening. Now the question is, are you going to recognize this expense basis on whatever payment you have made, or you would be doing something different? So the answer is We are not driven by the cash basis accounting. We are driven by the accrual basis accounting, right? So whatever is the total annual expense estimated divided by the 4 quarters, right? So irrespective of the advance payment, expense will be recorded on a accrual basis, right? So that's why we are calculating what? Average effective contribution rate, and similarly accounting the expense. But because in this question there was no figures given, only the question is asked in terms of guiding principle, so we are giving our answer accordingly, right? So this is how we are structuring our answer on this. Clear? Then second matter, the cost of a planned overhaul expenditure is expected to occur in the later part of the year and is not anticipated for the interim reporting purposes unless the event has caused the entity to have a legal or constructive obligation. The mere intention of the management to incur some expenditure on the renovation in the future is not sufficient to give rise to an obligation, because there is no present obligation and hence there is no liability and hence there is no provision required to be recognized in the interim financial year. So this expense will be recorded as and when the renovation takes place, right? So just management wanting to do some renovation in future doesn't mean that I record the provision today, right? Clear? Third one, the bonus. The bonus is anticipated for the interim reporting period if and only if the bonus is a legal obligation or a constructive obligation basis on the past practice that would make the bonus as a constructive obligation for which the entity has no realistic alternative but to make the bonus payment to its employees. And a reliable estimate of the obligation can be made. India's 19 employee benefits provides the guidance in this regard. A liability for the bonus may arise out of the legal agreement or the constructive obligation because of which it has no more alternative but to pay the bonus and accordingly needs to be accrued in the financial annual financial statements. Bonus liability is accrued in the interim financial statements on the same basis as they are accrued for the annual financial statements. In the instant case, the bonus liability is 10% of the operating profit for the year to date may be accrued. In the given case, since the company has past record of declaring the annual bonus every year, the same may be accrued using a reasonable estimate applying the principles of India's 19 employee benefits while preparing its interim results. So what do you mean by this? Are you going to record any bonus expense in the interim period or not? Yes, we are going to record the bonus in the interim period because what the guidance is. Guidance is, boss, guidance question, India is saying if the bonus payment is a legal obligation because you have given in writing to the employee that you will pay the bonus at the year end basis on the overall profits of the company, right? 10% of the profits. So this is a legal obligation. But if you have not agreed upon with the employees in writing, then it is not a legal obligation. But because you have been paying these bonuses for last many years, so you have set the expectation to all of your employees in their mind that this company pays the bonus every year, and hence this becomes your constructive obligation. Under India's 37 provisions, contingent liabilities and contingent assets, you must have studied that present obligation, if exist, either because of the legal obligation or because of the constructive obligation, doesn't matter whether it is a legal obligation, that is you have agreed upon in writing with the employees that you will pay the bonus, or it is a constructive obligation because by virtue of your past actions you have set the expectation that you will pay the bonus, then it becomes your present obligation, and because it is your present obligation, a provision needs to be recorded. Are you able to recall this discussion from your India's 37 class? Yes. Now, India's 19 says that as and when something is related to the employee, then India's 19 also gives the guidance. What India's 19 says that you need to estimate the liability on a reasonable basis, right? Now, how you will be calculating this then? So, what would be the reasonable basis? The reasonable basis is, for example, if for the financial year the company would have earned say 10,000 rupees as profits and 10% is the bonus, then how much is the bonus amount the company would be paying to its employees? 1,000 rupees. But because the financial year has not yet completed and we are sitting in the Q1 only of the financial year, and in the Q1 our profits is suppose 2,000 rupees, then how much bonus expense or liability we will record? 2,000 into my 10%, right? 200 rupees, right? Then in Q2, suppose additional 3,000 is earned, right? So how much is the total profit? 2,000 plus 3,000, 5,000. 5,000 into my 10%, right? How much it will be? 500. So accordingly, you will, as and when you are in the profits, you will continue to allocate in this fashion. Or there could be another way around. So suppose if you are sitting in the Q1 and you are having a profits of say 3,000, right? Or 2,000, let's keep the figure same. And the management has projected its future forecast of the sales and expenses for the Q2, Q3 and Q4, and thereby it has come up with certain estimated numbers of the profits. Then basis on those estimates, some amount of profit they expect to earn at the year end, they will apply the 10% rate on this and will record that expense. And as and when it moves to Q2, it is moves to Q3, they will start truing up that, right? So this is all the mechanics how the management estimates, right? So standard doesn't give bright lines how the estimates needs to be done, but standard says reasonable estimate, right? Clear? So back to your answer. You said that bonus expense will be recorded only at the year end is not correct. Clear? So bonus expense will also be recorded in the interim financial year. Now I'm again repeating few key learnings which we uh, learned from today's discussion. Interim financial reporting, India's 34, is no more a part of the annual financial year, right? It is an independent period. Okay. Why I'm emphasizing on this? So that you start treating the interim period as a full-fledged period only, right? It doesn't mean that it is a 3 month period, 4 month period, or 6 months period. It is not an annual year, so we can do anything. No, we cannot do anything. We have to follow the strict recognition and measurement guidelines or guidance for all the items coming in our interim financial reporting, the way we do the recognition and measurement at the year end while preparing the annual financial statement. So interim financial statements recognition and measurement is nowhere different to what we do in the annual financial statements. The only thing is different is the presentation. In interim financial reporting, presentation is condensed. We don't need to disclose all the line items in our balance sheet, P&L or cash flow. We can restrict to the condensed presentation. Similarly, we can do the selective notes to accounts disclosure or key transactions and events occurred during the interim period instead of disclosing all the full-fledged notes to accounts like we do in the annual financial statements. So should I make one bold statement now? One bold statement is India's one says complete financial statements. India's 34 says condensed financial statements. India's one says accurate recognition, accurate measurement. India's 34 says follow India's one for recognition and measurement, right? So recognition and measurement should be accurate for India's 34 as well. Then India's one says full-fledged presentation of the balance sheet, P&L statement of cash flow. India's 34 says condensed presentation. What is the difference? Condensed means fewer line items, important line items, right? Instead of disclosing all the line items like we do in annual, we can do a condensed balance sheet, condensed P&L. Then India's one says disclose all the notes to accounts required by all the Indiases. India's 34 says not required to disclose all the notes to accounts. Select key notes to accounts which are very peculiar and important, significant to the interim period, right? Fire broke out in the interim period, note will be given, right? uh, Inventory damaged and written off in the interim period, a specific note will be required to be given, right? So regular notes to accounts will not be forming part of the interim financial reporting, but significant transactions and key events which are occurred during the interim period, for all those transactions events, sufficient notes to be given. Is that clear? So only the presentation and disclosure requirements are condensed. Recognition and measurement requirements are not lesser. Clear? So whatever has to be recognized, the way it should be recognized in the annual, it will be recognized in the interim as well. All the incomes, all the expenses for that quarter will be recorded and reported in that quarter itself. No relaxation, right? But from presentation perspective, we will do the presentation, with a lesser line items, that is called condensed presentation. And we will do a selective notes to accounts. That's why relaxation is there in terms of the presentation and the disclosure only. But in terms of recognition and measurement, there is no relaxation. Clear? Okay. Any questions anybody wants to ask? No questions? Okay. So let's do the question number 6 before we complete the session today. While preparing interim financial statements for the half year ended 30th September 2002, an entity discovers a material error or a improper expense accrual in the interim financial statements for the period ended 30th September 2001, right? So while preparing the financial statements for which period? Half year, that is interim period. 30th September 2002, the entity discovered that there was an error occurred in the financial statements for the period ended 30th September 2001, that is last year, and the annual financial statements for the year ended March 31st, 2002 as well, because it was incurred in September 2021. So it was continuing in March annual financial as well. Right now, we are detecting it in the second half or first half of the next financial year. The entity does not intend to reinstate the comparative amounts for the prior period presented in the interim financial statement, as it believes that it would be sufficient to correct the error by restating the comparatives in the annual financial statements for the March 2003. So what entity is saying, because we are preparing a condensed financial statement, right, and we are preparing the interim financial statements for the half year only, so there is no requirement to correct the error in the half yearly financial, and we can do so while we prepare the annual financial statements. So that's the management contention. Is it acceptable? If yes, why? If not, why not? What do you think? Are you going to advise the client to correct the error in the half yearly results itself, or you can say no, 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 no worries, you do it in the annual? And even if you don't want to do it in annual, that is all your choice. We are here to support you. Just pay our fees on time, huh? Correct. So management contention is not right in this case, right? Because standard, casts the responsibility of the correcting the errors as soon as they come to our notice, right? We cannot wait, and we cannot say that although we have come to know about this error, but we are not going to correct it now. Let's correct in the annual financial, or let's correct in the next upcoming financial year, because if we correct this error now, our earnings will significantly be impacted, and hence our investors will ask questions, lot of questions to us. So let's not get into that mess. Let's skip. No, we cannot do so. It has to be corrected. If it has come to light in the quarter, it will be corrected in that quarter. If it has come to light in the half year, it has to be corrected in the half year itself, right? So what the management will do or is supposed to do here? So management will correct the error while preparing the half yearly financials itself. And again, it will give the disclosures for this correction, as well as in the annual financial statements, it will disclose the complete disclosures, right? So paragraph 42 of the Ind AS 8 inter alia states that an entity shall correct the material prior period errors retrospectively in the first set of the financial statements approved for issue after the discovery of the error, right? So as and when the error is discovered, so whatever period financial statements are going to be produced thereafter has to give effect of these error correction. That's what the para 42 of Ind AS 8 says. It mandates that you need to do the correction of errors in the first set of financial statement being produced after the discovery of the error, irrespective of the fact whether that financial statement is the interim or the annual, doesn't matter. Para 28 of Ind AS 34 requires that an entity to apply the same accounting policies in its interim financial statements as are applied in the annual financial statements, except for the accounting policy changes made after the date of most recent financial statements that are to be reflected in the next annual financial statement. So what the para 28 says? Para 28 says, boss, whatever the accounting policies you are following in your annual financial statements should be followed in the interim financial reporting as well. It shouldn't be different anywhere. Paragraph 15b of Ind AS 34 says, correction of the prior period errors as an example of events or transactions which need to be explained in an entity's interim financial report if they are significant to the understanding of the changes in the financial position or performance of the entity since the year end of the result annual financial since and of the entity since the end of the last annual period. So because you are correcting the error in the quarterly financial statement and the error pertains to the previous year, right? So in the quarterly financial statement, you need to explain how this error has occurred, how this is discovered, how this is corrected, and what would have been the impact on my previous financial statement had this error not occurred in the previous financial year itself, right? By putting the corrected EPS, earning per share, in the notes to account. So paragraph 15b mandates you to disclose sufficient information in your interim financial statements about this error correction, right? So you are not only correcting the error, you are also explaining a note about this error correction in your interim financial statements itself, right? That is a mandate. Then paragraph 25 of Ind AS 34 states as follows. While judgment is always required in assessing the materiality, the standard basis the recognition and disclosure decisions on the data of the interim period itself for the reasons of understandability of the interim figures. Thus, for example, unusual items, changes in accounting policies or estimates and errors recognized and disclosed on the basis of the materiality in relation to the interim period data to avoid misleading references that might result from the non-disclosure. The overriding goal is to ensure the interim financial report includes all information that is relevant to the understanding. So what is the objective? Okay, so let's understand what is the objective. The objective is to empower the users of the financial statements to understand the financial statements effectively. Yes or no? So from that angle, if we are only doing the correction of error, but we are not explaining what was the error, how it was discovered, how it is corrected, what would have been the impact had the error not occurred in the previous year, then do you think the users of the financial statement will be able to know about this error without the disclosure? No. So that's why standard says that if it is required for the understandability of the interim financial statement, understandability of the interim financial statement, then disclosure is also mandate to be given. And whether the error is material or not to be corrected, that also needs to be assessed first. It's not about if in 1 million balance sheet a 100 rupee error was there and you are going to correct 100 rupee error unnecessarily, making the financials complicated, right? So materiality is also one thing which we need to keep in our mind while deciding upon whether the error really requires correction or we can simply ignore, right? So materiality also needs to be considered. In view of above all the guidance, the entity is required to correct the error and restate the comparative amounts in the financial statements for the half year ended 30th September 2002 itself, rather than waiting for the annual financial statements. Did you like how the answer is presented for this question with lot of paragraph supports? Correct. So I will not say that you need to, give all the paragraph numbers, but try to give the answer with the support, some support, right? Simply saying yes or no doesn't, look good, right? So examiner wants to check your knowledge as well, rather than whether you have answered it correctly as yes or no, right? So just try to explain the basis of conclusion as well. If you are able to remember these para numbers, important para numbers, then good. But if you are not, at least mention the standard number, right? So India's 8, India's 34, India's 37, like all the standards, whichever are applicable as and when we are answering, right? Any questions? So that was it from my side on India's 1 and India's 34. I hope the session was informative for all of you. I tried to make it interactive and useful. I hope you find it. With that note, I wish you all the very best for your examinations. See you as a chartered accountant. Session is over, Ashokji. Thank you. Signing off. Have a good day. Bye. Yes.